Rapid inflation, skyrocketing oil cost, and global uncertainty have prompted economists to significantly cut their economic growth projections for this year and increase their odds of an outright contraction. Investors are concerned about the same thing. The bond market flashed a warning signal last week when the yield curve inverted, which has preceded the past several economic recessions. However, such projections may appear perplexing at a time when the economy is prospering by many measures. The United States has recovered more than 90% of the jobs lost during the pandemic's early weeks, and firms are continuing to hire at a fast pace, adding 431,000 jobs in March alone. The jobless rate has decreased to 3.6%, just above the pre-pandemic level, which was itself a half-century low. Nevertheless, doomsayers believe that the amazing resilience of the recovery contains the seeds of its own demise. Demand for automobiles, housing, restaurant meals, and the labor required to prepare them has outstripped supply, resulting in the fastest inflation in 40 years. Federal Reserve policymakers contend that they can cool the economy and bring inflation down without increasing unemployment or precipitating a recession.
Our goal is to get demand, use our tools to get demand and supply back in sync so that inflation moves down, and do so without a slowdown that amounts to a recession. That's our goal.
However, many economists doubt that the Fed can orchestrate such a soft landing, particularly at this time of heightened global uncertainty. Could the Fed push us into a recession? It's entirely possible, but my view is that this cycle is much more durable than some critics think it is. It's expected that the high oil prices, rising interest rates, and diminishing government assistance will all weigh on growth this year. On the other hand, business profits are robust, household savings are at an all-time high, and debt loads are low, all of which should act as a buffer against any slowdown. Many people with more money means more spending, the opposite of a recession. Similarly, employers are adding hundreds of thousands of jobs each month and would recruit many more if they could find qualified candidates. Consumers are spending, firms are investing, and wages are increasing at a rate not seen in decades. Also, the Federal Reserve is raising rates, but its signal is that it's going to stop below 3%, which is still historically low. So, in the end, my bet is that there is no recession, or if there is one, then it will be shallow. More like 2001, less like 2008.